All right, welcome back, traders. John Caruso here with another edition of Futures Forecast for the week of December 12th. We are recording Sunday evening, December 11th. We're going to do a quick review of last week and some of the trading action that ensued, and of course, some of the key data points that we did receive. And then we're going to do a quick look at the charts and kind of see how things might play out going into this week's very pivotal CPI number, and of course, followed up by that the December FOMC meeting on Wednesday. So first, a quick review of last week. Of course, we did see the November PPI data come out on Friday, and we did see that accelerate on a month-over-month basis. That was up 0.3%, clearly a negative to the market. The market did not want to see that month-over-month number accelerate. And of course, earlier in the week, we did see the ISM services number that came out, and that was, of course, quite hawkish as well. And even prior to the ISM services number, of course, we did see the increase in the month-over-month wages in the November labor report. So we've had a string of hawkish data points, clearly that developed in the stock market last week. We did see the S&P 500 down 4 out of 5 sessions last week, finished the week down 3.5%. The NASDAQ was down 3.69%. We did see a slight uptick in bond yields. The 10-year yield did climb 3 basis points. Gold prices were largely flat to lower. They were down 0.8%. Silver prices were up a shade inside of 1% for the week. The big story and the big risk off clearly came in the energy space. We did see crude oil finish down 11.75% for the week. RBOB, heating oil, both down 11% as well. We did see a slight uptick in the natural gas market into the end of the week. It was largely down for the better part of the week, but then Thursday, Friday, it was able to put together a rally to finish the week up 0.41% for the week. Couple of things that I was reading this weekend, some very insightful articles out of Barron's, the one of which was with longtime financial journalist and Barron's writer Randall Forsyth, did a Q&A with Felix Zulauf, who's been a longtime member of the Barron's Roundtable. Of course, he heads Zulauf Consulting over in Switzerland, and kind of goes through what he sees in terms of the macroeconomic cycle coming down the road. His thinking is largely in line with my thinking. He still sees plenty of risk for the stock market out into 2023. A likely oncoming corporate earnings and profits recession is likely going to drive asset valuations lower. And of course, the lower corporate profits and earnings is likely going to stem from a rise in the unemployment rate and a much softer consumer out into 2023. And that's kind of his take. My line of thinking is very much in line with his. However, he does actually allude to the idea that the Fed could pivot in the second quarter of 2023, which would be very, very interesting to see. I'm actually currently in the no pivot camp. I actually do think they will raise rates, of course, to 5, maybe 5.25%, and then they are going to hold them there. And if I am incorrect and they do look at pivoting in the second quarter, naturally asset prices are going to like that idea over the very near term. But from a longer term perspective, I think that would be a grave mistake, because I do think a pivot in the interest rate cycle, I think that would only reignite the inflation pressures. And you have to start thinking about the recession of 1974 and 75 and all the inflationary pressures that we were experiencing up until that recession. And then, of course, Arthur Burns and the Fed came along and started to cut interest rates while we hit that period of recession in the United States economy. Inflation, the inflation dragon, we'll call it, still had not been fully slayed. And that only reignited inflation into the back half of the 1970s. And it wasn't only until Paul Volcker, of course, came out and raised interest rates very, very quickly to eventually put out the inflation fire. So I do think that that would be a grave mistake if the Fed were to pivot and actually cut interest rates in Q2 of next year, as Zulauf alludes to. I was also reading Larry Summers. He's the former Treasury Secretary of the United States over the weekend, and he suggested that he thinks there is significant risks that the Fed could pivot early without fully reaching their 2% inflation target. And of course, he mentions that that has significant risks that come along with that. He actually compares it to a patient being prescribed antibiotics. The patient begins to feel better, but doesn't fully take all of the antibiotics through the full course, and eventually has to once again retake the medicine. I thought that was actually a pretty clever analogy that he had used. So that's a look at some of what we've seen develop over the last week. Let's take a look at the charts now. We're going to take a look at the March S&P 500. Clearly, we've got this upward bias that's been going on since October 10th in the market. But if I zoom out here, clearly this market has been painting a much more bearish picture. Clearly bearish trend, but we do have this month and a half upward bullish trade that has been developing. We did actually believe when we started putting some of this analysis in that we were going to get a rally into this long-term downtrend line into the 200-day moving average, perhaps fail. But at one point, it actually did look like it was going to try to take the higher track up to the 78.6 before once again failing out after the first of the year. But as you can see clearly, all paths we have drawn in here lead to lower stock prices out in the first quarter of next year. So I remain a bear. If we were to start to see a little bit of a wiggle, a little bit of a chop back into this 4,000 area, I think that that's going to be a fairly appropriate place to start looking at resetting some of those bearish strategies, perhaps utilizing the options market or a combination of futures and options for something much bigger on the downside going out into, we're going to say the end of January to potentially early February after we do start to get a look at those Q4 earnings reports that start coming out in January. So that's a look at the March S&P 500. We're still clearly holding and carrying a bearish bias for U.S. equity prices out into 2023. Let's flip over and take a look at the February gold contract. Clearly, we were bearish trend for the better part of the year. Then we saw something change over here. We had the better than expected CPI number that came out in early November. Market had a big upward thrust, and we've been trading higher ever since. When we did take out this 1740 area in the market, that did flip our models to bullish trend in gold. And clearly, we've been trading with a bullish bias ever since. It's actually following these cycles pretty beautifully, I might say so myself. So we got this rally into this 1830 level that we had mentioned. We did not think that we were going to see runaway gold prices up into here. We actually thought that the highest probability was we were going to get a rotation back to the downside. And that's where we're at right now. So if you ask me where the next 2 to 3% in price movement in gold is going to come, I'm going to tell you it's going to come back on the downside. So we've got key support levels drawn in here. The highest estimate of this correction would be to about 1740 before perhaps we get a bounce. And the lowest estimate is down here to about 1690. So we're going to say the accumulation zone for gold, or the bullish target zones for gold, to start looking at re-adding those long side strategies, come in between 1740 and 1690. If this analysis proves to be incorrect, we're going to get a warning sign if it starts breaking down here about 1680. And then, of course, this analysis will be incorrect if we do take out this old triple bottom down here, down at 1620, for perhaps some pretty substantially lower gold prices coming down the road. But we remain bullish on gold prices. I do think that we've got this big inverted head and shoulders bias that's developing on the chart, and we're going to continue to trade gold with a bullish bias from here. So now we're going to take a look at the March silver contract. Actually, we've got a lot of guys trading silver on this side. Starting to see some signs of fatigue up in here in the silver market. We're going to see if perhaps we can pull down into this trend line, comes in down along 2230 roughly. Clearly, we're struggling a little bit here at the 61.8. We'll see if we can regroup a little bit down here off of 2230, 2240 before perhaps we try to reattack higher up around 70 to 78.6 fib level in the March silver contract. So clearly an upward bias, bullish trend in our models here. Not quite getting an oversold signal. Perhaps the oscillators can come back down in here, trigger oversold, and perhaps that lines up with a little bit of a pullback down here before we can regroup and attack higher prices of the silver contract. So I remain bullish on March silver going forward. And lastly, we're going to take a look at the crude oil market. Crude oil, just an absolutely wretched week for oil prices. Taking a look at the daily here. Clearly, this downward bias since looks like May, June in the market. We did hit a period of consolidation. We were just kind of some sideways chop, and then we broke this key level over here, which was we're going to say about 81.50. Broke down through there, and the bear market trading was back on. We actually did think that we could retrace up into this 84.70 area. You can see I still have my alarm set in there. I was waiting for that alarm to trip before sending a sell signal to some of our traders. We never quite got that high. Market took a little bit of a steeper correction back on the upside, got as high as about 83.46 before we started to rotate back on the downside. We are no longer oversold. We were oversold at one point last week. Market has since sweated off that oversold level. Clearly negative momentum here. And I've got downside targets in oil that come in closer to about 65. We're going to say 65. And that's going to be the highest estimate of our downside target. The lowest estimate is, you can see we have this falling wedge pattern that if we can sneak back into this level here, perhaps we get as low as 63 and perhaps as deep as 57. So 65 is my base case right now that the oil market's going to test, with the potential to get all the way down here to about 57 before perhaps we see some bargain hunters and some value buyers come back into that market and begin to push oil prices higher. I do think oil prices are clearly the supply side story of crude oil. It's not going to improve. But clearly this market, it's clearly risk off. It's clearly front running oncoming demand destruction in the form of potentially a global recession. And I've gone through these cycles many, many times. And right now, crude oil is behaving as if the global economy is going to experience demand destruction and move into a global recession out into 2023. Longer term, much longer term outlook, I do think oil prices are likely going to trade higher into the end of 2023 and through 2024 for perhaps substantially higher oil prices out into the future. But that's not what is in front of us at the moment. And clearly, crude oil should only be traded with a bearish bias from here. So, all right, that will wrap up futures forecast for the week of December 12th. If you have any questions, feel free to ping me at jcaruso@rgofutures.com. If you want to jump on our morning market insight letter, I do write a synopsis of the market and some things that we're looking at every single morning that we send out to our traders. I'd be more than happy to add you to that list. Feel free to reach out anytime. Once again, jcaruso@rgofutures.com. Best of luck to everybody out there. We'll catch you back here next week. Take care.